Hello children, welcome to the online session of Sri Gokulam Guruvayur. See children, in our previous class we were discussing chapter 3 Goodwill, Nature and its Valuation. In that class we have discussed the average profit method. We did problem with simple average profit method and weighted average profit method. Today's topic for discussion is how to calculate the goodwill with super profit method. So here is the super profit method. Similar amount of capital employed yield different profits for different enterprises. So if you are taking two enterprises, that is A Limited and B Limited, they are the two enterprises, and suppose the capital employed by these firms are similar, but the profit earned by this firm will be different. So what does that mean? That means it have different functions performed in that enterprises. So according to the different functions and the way of dealings and all that, the profit earned by the firm will be different. Though the capital employed by this enterprise, even if it is similar, the profit will be different. When a similar type of business earns profit at a certain percentage of capital employed, it is called normal return. So, if similar type of business are earning profit at some percentage, a certain percentage of capital employed, those or it is known as capital return. The excess of average profit over normal profit is known as super profit. So in if you are asked what is super profit, in short, what is your explanation? It is the excess of your actual or average profit. You know how to calculate the average profit. In our previous class we have studied the calculation of average profit. So if your average profit is over than normal profit, it is known as super profit. Okay. Now capital employed. What do you mean by capital employed? Capital employed means capital invested in the firm to carry on business. You know that term very well, capital. It is calculated to determine the value of goodwill. So sometimes in your problem, capital employed will be absent. So in that case, you will have to calculate that amount. So two approaches are available to calculate the amount of capital employed. Liability side approach is also there and asset side approach is also there. So in liability side approach, the formula goes this way. Capital employed is equal to capital plus reserve minus goodwill if any existing in the book. If balance sheet some old goodwill is there, then that will have to be deducted, minus fictitious assets minus non-trade investment. So this is the formula to be used to calculate capital employed when it is liability side approach. And if it is you are following the asset side approach, the formula goes this way. Capital employed is equal to all the assets except goodwill, comma, non-trade investment and fictitious asset minus outside liability. So actually all asset minus outside liability, but while calculating all assets, you don't have to calculate goodwill, non-trade investments and fictitious asset. Avoiding these three items, rest of all the asset you have to take. From that you subtract outside liability, then you will get capital employed. So this is the formula. You know that asset minus liability is capital. So that formula have been used over here. So using any one of the approach or using the one approach which is as per which the information is provided in the question, you will get the amount of capital employed, which is one of the item required for calculation of super profit. So children, you need for calculating super profit, you need capital employed. You should learn what is super profit. It is the excess of average profit over normal profit. Then you should know what is normal return. Okay. Now these are the steps for calculating goodwill under super profit method. The first method is you have to calculate the average capital employed. So we already discussed the capital employed, how to find the capital employed using any one of this approach. So opening capital employed plus closing capital employed divided by 2, you will get the average capital employed. Okay. Then second step is calculate adjusted business profit, that is actual average profit. Profit earned by the firm for the year is adjusted for the abnormal gain and losses, if any, and recurring expenses that have not been incurred. The profit so determined is total and its average. See, you know the calculation of average profit method from our last problem. The same you have to use here as a second step. Now step 3. Step 3 is calculation of normal profit. Now how to calculate normal profit? Average capital employed. Okay. Average capital employed. From your step 1 you will get the answer for this. Average capital employed into normal rate of return, that will be also provided in the question, that is normal rate of return, divided by 100. So normal rate of return means the rate of return normally earned by other firms in a similar industries. So it will be provided in the question, that you have to write this. Then step 4 is calculate super profit. What is the formula for calculating super profit? Actual average profit that you will get from your step number 2, and normal profit you will get from step number 3. So from step number 2, if you subtract step number 3's amount, you will get super profit. Now how to calculate goodwill? The formula to calculate goodwill is super profit into number of years purchase. So super profit you will get from step 4 into number of years purchase will be provided in the question. So following these 5 steps you will get the answer for super profit. Okay, valuation of goodwill using the super profit. Let us see one more concept is there, trade investment. So we know the capital employed, there is one trade investment and non-trade investment. So some information is provided over here. Trade investment are those investments that are made in another enterprise for the furtherance of own business. For the progress of our own business, if we are investing our investments in some another enterprise, it is known as trade investment. And what do you mean by non-trade investments? Are those investments that are made to earn revenue by investing surplus funds and not for the purpose of furtherance of our business. We are here in non-trade investment, our motive is to earn revenue, okay, by investing surplus fund. Whatever surplus fund is there in our business, we are investing them so that we can earn revenue. And trade investments are those investments that are made in some other enterprise for the progress of our own business. Okay, so this is the two difference concept related to trade investments. Now, unless investments are specified to be trade investment, they are taken as non-trade investment. See, usually non-trade investment you have to take. If it is mentioned particularly that it is a trade investment, then only you have to consider as a non-trade investment. They have to specify it that it is a trade investment. Otherwise, you will have to consider it as a non-trade investment. Now let us do one problem. A firm earned net profit during the last 3 years. See, last 3 years profit is given to you. The capital investment of the firm is 60,000. See, capital employed or capital investment is given to you. So here no need of calculating it. Normal rate of return is 10%. Normal rate of return is also denoted by NRR. Okay. Then Calculate value of goodwill on the basis of 3 years purchase of average super profit for the last 3 years. So here you have to see that underline 3 years purchase. Average profit is 3 years purchase. Okay, so now let us move to the solution part of this problem. The first step is to find the average profit. How to find the average profit? Adding all the 3 years profit. So year first is 18,000, year second is 20,000, and third year it is 22,000. Add them together and divide by 3. What is this 3? This is, you are taking the average, so you have to write the number of years taken. So 3 years profit you are adding, so 3 divided by 3. After dividing by 3, you will get 20,000. So here you got your average profit. Now normal profit. The formula for calculating the normal profit is average capital employed into normal rate of return divided by 100. Okay, so what is your capital employed? How much capital have been invested in the business? 60,000. So 60,000 into what is your NRR or normal rate of return? Normal rate is 10%. So write down here 10 divided by 100. So calculating this, you will get 6,000. So you got average profit, you got normal profit. What is the formula for super profit? Super profit, the formula is average profit minus normal profit. So average profit you calculated with step 1. Normal profit you calculated with step 2. Subtracting this, you will get 14,000. So goodwill is equal to, what is the formula for calculating goodwill? Super profit into number of years purchase. Super profit you got from step 3, that is 14,000, into number of years purchase you have underlined as 3 here. So into 3 you will get 42,000. With this 4 simple step, you got the value of goodwill from super profit method. It's very simple. Okay. Now one more problem is there. Alok and Akash are partners in M/S Mega Enterprise. They admit Ashish as partner with effect from 1st April 2020. So these were the two partners, and later on they admitted Ashish on 1st April 2020. They agreed to value goodwill at 3 years purchase by super profit method. So you can underline here that how many years purchase is mentioned over here? It's 3 years purchase. Okay, so with that you just underline it. It's 3 years purchase by super profit method, for which they decided to take average of 5 years profit. So in front of you it is given the 5 years profit. So you can see here some abnormal gain and abnormal losses are given to you. Capital employed in the firm is 15 lakh and normal rate of return in the similar business is 10%. Calculate value of goodwill. So this is the question in front of you. Now you have to move to the solution part. See, follow those steps. First thing is you calculate the average profit. Second thing is you calculate the normal profit. Third thing is you calculate the super profit, and the fourth and the last step is calculation of goodwill. So let us find the average profit. So you know the calculation of average profit. If you have practiced and you watch the lecture video of average profit method, you may able to do this. So you write the year first and write the profit of that particular year, and the adjustment is given here, including in this 2 lakh a gain of 25,000 of sale of fixed asset is included. So that it's not supposed to be included, and by mistake it have been included. So you have to subtract it and you will get the actual adjusted normal profit. And in the year 31st March 2017, the 1,70,000, there was it was included as an abnormal loss of 50,000. So abnormal loss was included here, that is subtracted from this, that have to be included. So you will get the actual normal profit. After deducting and adding all the abnormal gains and abnormal losses, what you will get is your normal profit. After adding all your normal profit, you will get the amount of total normal profit. Now we have to calculate the actual average profit. So total normal profit divided by the number of years. So this you got from this table, and dividing it with 5. What is this 5? Number of years, that is 2016 to 2020, it is 5 years. So that 5 you have to divide, and you will get actual average profit. So first part is over. Now second step, calculation of normal profit. What is the formula? Capital employed into NRR. What do you mean by NRR? Normal rate of return. So capital employed is also given in the question. How much it is? It is given that capital employed is 15 lakh. So 15 lakh into what is the rate of normal rate of return? It is also mentioned that it is 10%. Normal rate of return is 10%. So 10 divided by 100, you will get, calculating this, you will get normal profit as 1,50,000. So your second step is also over. Now calculation of super profit. So what is the formula for calculating super profit? Actual average profit minus normal profit. Actual average profit you got from step 1 and normal profit you got from step 2. Subtracting this, you will get the answer as 67,000. Now fourth step is value of goodwill. What is the formula? Goodwill is equal to super profit into number of years purchase. So super profit you got from step 3, that is 67,000. Step 3 into number of years purchase, we have already read the question and underlined that as 3 years purchase. So 67,000 into 3, you will get 2,01,000. So these are the 4 steps which will help you to get the answer for your requirement, that is calculate the value of goodwill is your question. So the answer for goodwill calculation is super profit into number of years purchase. So following this 4 step, you will get the required answer. So children, now it is time to conclude today's session. In today's class, we studied how to calculate goodwill under super profit method. We saw that certain steps we have to follow, and some formulas are also there to calculate this. With practice, you can get thorough with the calculation of goodwill using super profit method. So I expect that you will practice some more problems from your textbook. Attend the test paper attached. So meet you in the next class with the new method of calculation of goodwill. So till then, goodbye.